Now, if we're anticipating the likely draw to a discount 5-minute buy side and balance, sell side efficiency, fair value gap, that's this levels here I mentioned, or maybe drawing down into that 15-minute time frame discount, buy side and balance, sell side efficiency, consequent encroachment, the midpoint of that 15-minute gap. Look at the bodies where they're coalescing at. Look at that right there. Isn't that interesting? And look what price is doing right now. So the market, while up here at 3 o'clock, that candle right there just perfectly touches what I teach you as a bearish order block, which is absolutely not a fucking supply and demand zone. It's not. It has absolutely nothing to do with that. Okay, that's nothing. This level is a specific price level. It's not a zone. It's not something random. I'm not plucking it out of my ass. It's really going to be there in the chart. It's really going to be repeating. The phenomenon repeats itself all the time because it's algorithmically delivered. So inside that 5-minute breaker, which is bearish, the market trades up into that one right there on this up close candle. Okay, what is it doing? Before I say anything more about what, let me zoom in a little bit, because I know you're watching real-time price action. Pay attention to the lesson. What's occurring? I know. It seems like advertising. It's just, I got to keep these jokers honest. Inside of the 5-minute bearish breaker, right here on this candle at 307, what's occurring? The market's trading up into the 5-minute bearish breaker, which is shaded in this shaded area here. It's trading to the low of the inversion fair value gap that you're going to draw from the 5-minute chart. It's not in my chart now. That's the interactive part for you to put in your chart. It trades up to it here. And this down close candle right there. But ICT, look, it has that big wick. I don't give a shit. That wick right there has no bearing on what it is I'm talking about. The down close, I'm sorry, the up close rather, I said that incorrectly, sorry. The up close candle is a bearish order block. So that up close candle, when it's trading to it here, there's two things going on the 1-minute chart right there. Two things are occurring. It's trading to the breaker and inversion fair value gap on the 5-minute time frame. And on the 1-minute chart, it's trading up into a bearish order block. So when you see folks out there saying order blocks are just engulfing candles, that's horseshit too. It's nothing to do with engulfing anything. When the price is in a sell side delivery, okay, in other words, at 3 o'clock, the price starts its run and the macro begins seeking sell side, which is running here, and then aiming for lower sell side liquidity, which is below old lows or singular low. Every single time the market creates a up close candle in that sell side delivery price run, in other words, you're calling it a trending market. This is not a trending market. This is just a market that's declining. So that's why I don't use those terms, trending, because price swings are not trends. They're not to me. They're price runs. So if I'm expecting and anticipating price running to lower targets into a discount, either for the purposes of going to a fair value gap that's lower than market price, or to a low or relative equal lows for sell side liquidity, either one of those scenarios will provide me the context to anticipate lower prices. While I'm watching price, if I see something like this where we open, we trade down, and we rally up like this, if I'm short, I'm not freaking out over that. I want to see how we see the first up close candle when sell side begins its delivery. Because once we get our price run here at 3 o'clock and we snap below that candle that created it, what kind of candle is that? Is it up close or down close? Up close. So when we break below that, I want to see when price starts to run, we're in an area where I anticipate what's the inversion fair value gap expected to do? Create a resistance factor in price. It should accumulate more shorts. It should offer smart money the opportunity to get in and add, or like you see me many times do, pyramid more short positions in an existing short position. Our next up close candle is this one. Does it respect it? I don't know. What does it do on this one? Does it bump the bottom of it and run lower? The next candle? Yes. But you're looking at this and saying, but see, I got ICT by the balls right here. Here he is. He said that the silver bullet every single day it happens between 3 o'clock and 4 o'clock, between 10 o'clock and 11 o'clock, and 2 o'clock to 3 o'clock, and 3 o'clock to 4 o'clock. There's 4 opportunities for you to quit your fucking job, and you're worrying about everything else in the world about trading and who's doing well on social media. Stop. You're missing these opportunities because you're not focusing. You have to look at this price action in the times I'm telling you to study it, and you will see exactly what I've said is the truth. It's not made up. It's not contrived. It's not mythology. It's not animal patterns. It's not anything but the truth. Because of the framework that is outlined to you here. What time frame is this? What's up here? The 1 minute chart. Okay. What I'm about to show you is going to make some of you uncomfortable because you either don't have access to these types of time frames or you're afraid of them. You think that they're going to do something that would be alien to what would be expected on higher time frames. Some of you would look at a 1 minute chart and say, okay, I trust a 1 minute chart, but I could never trust a 30-minute or a 30-second chart. 30-second chart is just too fast. No, it's not. It's the same price. It's doing the same thing. If you put a 30-second chart, a 5-second chart, a 1-second chart next to an hourly chart, the same market price is being reflected on the hourly candlestick that's going to be shown on a 1-second chart. You just don't know how to reprice. What's this level right here? The new day opening gap high. And this level here. New day opening gap low. This up close candle is in what portion of that range? The premium side of it. In other words, it's from between this candles, I'm sorry, not candle, but this level here and this level here. Split that in half. Right in here. So this up close candle is in the premium side of that new day opening gap. If we're bearish, do we want to see it trade back to the premium end of that once we break below halfway, which is here on this down close candle right there? Once it goes down halfway between new day opening gap high and low, what are we seeing? We're seeing the market break down. We're seeing proof that the algorithm, the thing that actually controls price, and I know some of you don't like to believe it, can't believe it, won't accept it. I don't give a shit. The point is it's going to keep doing it. It's going to do it every week, every day, and it won't stop. So right in here, in this little area here, we're going to look at these two, well, this little range in here. You can already see there's a highlighted shaded area here. I have that so that way you can see in contrast. You're probably going to hear Piper, which is one of my puppies. She's next to me snoring. So just if she's heard, just know that there's nothing I can do about it. The bumping of the low of that bearish breaker and inversion fair value gap that you'll have on your chart drawn from the 5-minute basis. This little shaded pink area is denoting where on a 30-second chart, here's that 5-minute breaker. The market trades lower, and then we're bumping it right there on that candle. Now, right at that candle at 3:07 and 30 seconds, what's actually occurring there? The market leaves that 5-minute breaker, and it bumps into the inversion fair value gap and the 5-minute breaker right on that candle. And more specifically, it's going right into the gap between this candle's low and this candle's high right there. That right there is your London session ICT bearish silver bullet. It's going to fucking be there every day. If you don't know how to read price, if you don't know where it's going to go, if you don't know how to read the tape, this is reading the tape, anticipating where it's going to go. Fucking level 2 data, your order book bullshit, has absolutely no rhyme or reason why price is going to go there. That's spoofing. You can fake all that stuff. You can't fake or spoof the open, high, low, and close of these candles as they're forming. You can't spoof reading actual real-time price action. You can't spoof that. You can do it incorrectly. But once you understand what you're looking for, You're anticipating these things. Once the market's likely to keep going lower, that means you're in sell side delivery. That means the market's going to go lower to take stops below old lows or reach into an inefficiency below the market price. That means some kind of fair value gap below market price. Where was that at this point right here? All the way down here. Your hair snoring. Hang on here. Let me get this to show the level. Well, I don't think I have it highlighted for that level. Well, we can use the 5-minute fair value gap. So if we were anticipating that level, don't worry, I'll show you what all this is here in a second. But if we're looking for an entry here for the silver bullet, and we're looking for it to trade down into sell side, this red level here is the sell side liquidity pool below the relative equal lows on this level here. That's this red level here. So if we go back into the 30-second chart, and we're trading in this level here, inside the silver bullet, right there. But ICT, I don't have the access to 30-second charts. Get it, because you're going to miss some of the silver bullets if you don't. Okay, because all I'm looking for is that small little separation where there's an actual inefficiency. And I'm going to tell you exactly what's going on right now. At that moment, right in here, as soon as price trades to this candle's high, and as long as the market is above half of this candle's body, which is mean threshold, algorithms, high frequency trading algorithms, are firing in short orders constantly. Boom, 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 as fast as you can get them in there. As fast as the market will absorb it and take them in, high frequency trading algorithms are selling the fuck out of that. And it slows down when it gets to about right there. That selling by the algorithms is not pushing price down. Because if it was, it wouldn't trade up while it was doing it. The market goes up to offer the entity that I collectively refer to as smart money. You're not going to see them. They're not writing books out there. They're not going out there and making courses for you. Okay. In 2010, I went rogue, and you are learning about these things that you would otherwise never even seen, learned, talked about. Nobody's ever done it before, and fair value gaps are not support resistance on lower time frames. And no, you can't use moving averages. That's all bullshit. That's all bullshit. These are cop-out excuses for people that are selling Mickey Mouse shit that doesn't work. This is the truth behind the marketplace. You've watched me do this live in front of you. You've watched me trade with real accounts, live money. It's reality, folks. You won't believe it until you see it yourself. And once you experience it and you start seeing it repeat, doing backtesting, doing what I'm showing you right here, this is backtesting. This is my way of backtesting, looking for these signatures in price action, collecting the data, and then taking a snapshot of the charts like this in like small little areas over here or over here. You write out your observations and you record as if you anticipated that happening real time. That's positive self-talk. What you're doing is you're creating pseudo experience, which is far better than using something like a market replay report, which is absolutely horseshit. That's not real results. This is where you're going into the chart and you're specifically looking at an element of price delivery and you're internalizing it. You're recording it with an emotional stimuli that at the time when you're doing the back testing, you're talking in the chart like, or the annotations rather, like you really saw it happening. With the pretense that you will go into that journal log entry at the end of the week, at the end of the month, and you reflect, constantly looking at it. And when you read your annotations, your subconscious reads the fact that I saw that, I was happy, I'm satisfied to see price behaving like I expected, and it's filtering out all the negative. The best way to encourage, if you have a child, they're going to want to do well for you when you encourage them. You don't want them to be torn down and break their will by constantly scolding them and saying you're a failure, you're never going to amount to anything. Who would do that? Well, the trader inside of you, unless you are a well-equipped, consistently profitable trader right now, you are a trader in the making. You're an infant, and that's not derogatory. It's just you're not equipped with experience yet. But this right here, this little inefficiency, that shaded area, let me take this off. That little area between this candle's high, that candle's low, that's the silver bullet. Does price drop like this on your chart? Sure it did. Let's go back up to the 1 minute chart, because once the entry's done, you're probably asking yourself, where would your stop be on this right here? Where would your stop be? It would have to be above this candle's high. Well, that's too much risk. Don't take the trade. Trade with less leverage. You're trying to trade with 15 contracts because your funded account says, oh, you can trade with 15 contracts. That doesn't mean you should do it. All of you should be trading with the least amount of leverage, period. We're in a market condition that is absolutely ripe for a black swan event. That means something that is going to absolutely tear the shit out of everybody's ass, even me if I allow it, which is why I'm not trading with a lot of leverage. I'm not really pushing it right now. There's a lot of stuff going on geopolitically here in the States. I'm going to hold my tongue. I'm going to live stream on YouTube. This is going to turn into a Twitter space real quick. Just know that we have a lot of reasons to be respecting risk right now, and you shouldn't be doing a lot of carnival-like exercises in your trading. Let's go up to a 1 minute chart and wrap this one up, because a little bit longer than I wanted to be. But so when price starts its run here on a 1 minute chart, and preferably if you have access to less than 1 minute charts, you should never just have that second chart, whether it be a 30-second, 15-second, 5-second, 10-second, 1 second chart. You should not have that only on your chart or your workspace. You should have a time frame or two above it. In this case, if I was looking at the 30-second chart, I would have the 1 minute and 5 minute chart, because it helps you see all the other order flow that would be seen in the candlesticks. Up close candles when you're in sell side delivery should act as real resistance. That's what the algorithm refers to it as. It's an old area where it can be utilized to accumulate new shorts. The algorithm's not accumulating any shorts. It's delivering price for those individuals that participate with that intent purpose to maximize the exploitation of how price is delivered. On a 1 minute chart, after the price starts its run, again, here's that sell side delivery, or sell side liquidity rather, I'm sorry. Getting a little animated here. I don't need coffee, brother. Chemical imbalances do it for me. Sell side liquidity, relative equal lows, and the silver bullet here. So we're going to anticipate price drawing initial to this one, and over here. Here we accelerate to dig into this sell side liquidity pool there. So we create a sell side imbalance, buy side inefficiency, a SIBI. Remember, if it's a fair value gap, if it's a down close candle, that means it's a SIBI. That means we anticipate price at a later time, at some time, it's going to reach back up into it with the expectation that it should offer new opportunities to do what? Accumulate new shorts. If it were bearish, would we want to see this entire range completely repriced too on the upside of it? In other words, overlapped with movement up? No, we don't want to see that. Why? Because if it starts keeping these things open, remember I was teaching you about the 5 minute fair value gap here where it was left open. I would want to see that stay open on above this high here, not completely overlap that candle. The same idea there is what we would expect here. We want to see the upper portion of an inefficiency stay open. So every single time an inefficiency manifests itself in price, if I'm bearish, I am actively interested in seeing if it stays open. The upper half of it needs to stay open. As long as it's doing that, that gives it lots of room to keep going down. So if it's not going to go in the upper portion of this gap and trade higher and close it in or reprice to it, we want to see the halfway point or less be sensitive. And here's 25% of this SIBI. I'll show you what that means. From this candle's low to this candle's high, 50% level there, and then 25%. Now, for the folks that want to see my Fibonacci level, here it is again. What I change is this one here. Sometimes if I want to do like a TGIF measurement on the weekly candle to see how far on a Thursday or Friday the market can retrace on a weekly range that's expanded higher or lower, Right now I have it set to 25 because I want to get the quadrant levels. If I want to use the TGIF, I take that off and it's going to be 0.2. So there's the distinction there. In case you've probably seen some discrepancies when I show my Fibonacci settings. These are the ones that are usually changing. Everything else pretty much stays static. So I want to see the quadrant level, lower quadrant or quarter of this range. You can see it here. 0.25 is the measurement from the candle's low to that candle's high. So if I'm bearish, I want to see the market respond aggressively and sell off at either the quarter or the halfway point and not trade up into here. Okay? Because the algorithm, if it does these things like that, that's like a warning sign for smart money to just be careful, don't add new positions. That's what it is, folks. I mean, it sounds like conspiracy theory, sounds like contrived Tom Clancy kind of shit, but that's just the way it is. Okay? It is the way it is. And you tell me, what's the price level here on this high, on that candle? You're going to be looking at it up here, okay? This upper left-hand corner. What's the high of that candle right there? 15,652.75. What's the quarter level? 15,652.75. Find that in your fucking supply and demand, okay? Find that in Wyckoff. Find that in Algo Box. It's not there, okay? All that stuff, folks, all that stuff is nonsense. That's not the real market. That's you trusting a religion of indicators. Some kind of archaic bullshit theology has absolutely no bearing on how price is going to go up or down and why it's going to go there and what time it's going to go there. So the market goes up into that range. We want to see it stay open. If it closes, then you have to deal with it differently. But every inefficiency, I'm trying to anticipate them staying open. If I'm bearish, I want to see the upper half stay open. If I'm bullish, I want to see the lower half stay open. They may come back down and reprice. If it comes down and reprices, and it hasn't, like for instance, if it hasn't gone below the sell side here, this is important stuff. These are the things that you need to be listening to and why these fucking live streams and videos are beneficial to you. This is the stuff you don't want to hear and see other people complaining, but this is the stuff that's going to make you fucking money. This is going to be the thing that helps you keep your money. If this would have repriced to the upper end of that candle's low, if it would have done that, and it did not go below this red level, which is the sell side liquidity pool on the 5-minute chart, that means that I would still be willing to hold the trade, but it needs to start dropping aggressively once it gets there. It cannot wait around and spend time like it was doing here, consolidating, and then goes to the lower quadrant of that sell side imbalance, buy side efficiency, then dropping. I don't want to see that once it does this, goes back up. If it would have done that, I would have held the trade. If it would have done that, but it would have been a time stop added to it. That means as soon as it touched this candle's low, it's got 2 fucking minutes to get in my favor and outside of that range here. If it doesn't do it, I'm taking half the trade off or all of it. Because the likelihood is they may not come back down here to take that sell side until New York. Big paradigm shift, what I just gave you there. For the new folks, it's going to feel like it was mumbo jumbo and means nothing. And it's because you're still too new to know what's good information. But that stuff is algorithmic. That is real mechanics behind how you manage a trade, how you manage risk, how do you anticipate and forecast future price delivery, and how you manage yourself psychologically, emotionally. All these things are predetermined protocols. I know exactly what I'm doing, how I'm going to do it, how I'm going to behave. I'm not surprised by price action. I'm not worried about missing a move. None of those things, because this is how I internalize price.